The stock market is over. The top is finally in. That's what the headlines were screaming last Friday when the Dow and gold took a nosedive. But then Monday morning hits and we see a massive green bounce. Now everyone is asking, was that just a glitch or is this the beginning of the end? If you've followed me for a while, you know I don't buy into the hype. I look at the data. And the data is telling me that while the mainstream media celebrates this week's recovery, the cracks in the foundation are getting wider. We are seeing volatility we haven't seen in years. This isn't random. There are 3 specific triggers happening right now in February 2026 that tell me we are walking on thin ice, and they all tie back to one man, Donald Trump. I'm not here to talk politics. I'm a British investor watching my portfolio. I want to break down these 3 triggers, including the massive news about the Federal Reserve that dropped 48 hours ago, and show you how to protect your wealth. Trigger number 1 is the escalation of the trade war. We always knew Trump wanted tariffs, but last week he took it to a nuclear level. You might have heard about the steel tariffs, but the real story is aerospace. Just days ago, on January 30th, Trump threatened to decertify Canadian-made aircraft, specifically targeting Bombardier. He's threatening a 50% tariff on planes crossing the border. This isn't just about protecting American jobs anymore. This is a direct blockade of high-tech industries. Canada is already scrambling to retaliate, and we are seeing supply chains for airlines shudder. Why does this matter to you? Because when you disrupt the transport and logistics sector, everything gets more expensive. We aren't just talking about a few cents on a flight ticket. We are talking about a rise in shipping costs that businesses will pass directly to you. The smooth trade we've enjoyed for decades is fracturing, and the market hasn't fully priced in the cost of this disruption yet. Trigger 2 is the geopolitical strain, specifically what analysts are calling the Greenland anomaly. Tensions between the US and its traditional European allies are at an all-time high. With the Munich Security Conference coming up in just a couple of weeks, the US is signaling it might pull back support if allies don't fall in line with its new Arctic strategy. Markets hate uncertainty. The volatility we saw last Friday was partially driven by rumors that major European powers are looking to de-dollarize their trade because they can't rely on US security guarantees. If the US dollar loses its grip as the global safe haven, the inflation we see today will look like a walk in the park. Trigger 3 is the one nobody is talking about enough, and it's the most critical update. For months, I've told you about the theory that Trump wants to control interest rates to service the $36 trillion national debt. Well, as of this week, that theory is basically confirmed. Trump has just nominated Kevin Warsh to succeed Jerome Powell as Federal Reserve Chair. Why is this huge? Because Warsh is seen as someone who aligns more closely with Trump's vision of growth at all costs. The market rallied on Monday because Wall Street thinks this means easy money and lower interest rates are coming back. But here's the trap. If they cut rates while inflation is still sticky and tariffs are rising, we could see a second wave of inflation that destroys purchasing power. They're trying to refinance the national debt by devaluing the currency you hold in your pocket. It's a short-term pump for the stock market, but a long-term risk for the dollar. So, with the market near all-time highs, but the risks mounting, what do? Step 1. Don't chase the green. When you see a day like Monday where tech stocks pop 2%, do not FOMO in. That is a sucker's rally. Keep your cash reserves high. I'm sitting on more cash than usual right now, waiting for the real correction. Step 2. Watch the 10-year Treasury. The 10-year Treasury yield is hovering around 4.24%. If this spikes up, it breaks the stock market. If it crashes down, it means a recession is here. Watch this number like a hawk. It tells the truth when the stock market lies. Step 3. Hard assets. With the Fed takeover looming, I'm doubling down on things the government can't print. Gold took a hit on Friday. I bought that dip. I'm also looking at Bitcoin and real estate. If the plan is to devalue the dollar to save the government, you want to own assets that float. The market isn't over, but the easy mode is. The volatility we saw to end January was a warning shot. The investors who ignore the warning and chase the highs will be the ones left holding the bag. The ones who prepare now, who build cash and buy quality assets when the fear returns, will build generational wealth. I'm going to be tracking the Kevin Warsh hearings closely. If you want my full breakdown on what his policies mean for your portfolio, make sure you're subscribed. Stay disciplined, and I'll see you in the next one.